Welcome back. If you've just joined us, you're watching Stockwatch, and joining me at the desk this evening are Gerbrand Smit from NeFG and Greg Katzenellenbogen from Sanlam Private Investments. Do send along your questions. You can SMS stock in the question to 33814, or you can email us at stockwatch@bdtv.co.za. Greg, Gerbrand, nice to have you both this evening. Greg, if I may start with you, interesting day on the market, and the three things that sort of occurred to me that maybe should make us very, very nervous indeed are what is happening to sovereign bond yields world over. I mean, the Swiss 50-year maturities have gone negative. US 10-year treasuries are now at record lows. German bunds have gone negative too. You've got Mark Carney warning about Brexit risks crystallizing. And you've got an Italian banking system in crisis that could maybe herald a next sort of round of, I suppose, turmoil in the European financial services sector.
Well, as the Chinese say, it's interesting times we're living in. It is concerning that yields have gone negative. So many countries are dipping negative. The German 10-year yield gone negative. But, in Switzerland, to give them money for 50 years and you have to pay for the pleasure, it just seems ridiculous. But if you're a financial institution with 5 or 10 billion in cash and you have to find a home, you can't just go and put that in equities. You have to put it somewhere in a bank, and putting it with the central banks is probably the safest place to be, knowing that it's going to you're paying a storage fee essentially.
Yeah, I mean, but that also, Gerbrand, suggests that the bond market must be telling us something. So if this is what's happening in the bond markets, then there must be some sort of forthcoming crisis, or is that just, is one making too much of it? And as Greg says, it's a temporary sort of holding place for cash.
Yeah, look, it's very interesting times, but yeah, I think it's a factor of deflation on a global front. So it's a lack of demand and no inflation in the system. So everybody is very scared at the moment that everybody is going to Japan type of scenario 20, 30 years back. And of course, everybody's trying negative yields at the moment to actually stimulate growth or demand on a global front. It's not happening yet. It is a scary world out there. Hopefully, it doesn't boil down to that. The first thing I watch every morning when I get to my PC is actually what the Chinese currency is doing against the dollar. And that's just because they're exporting deflation, because they've been weakening their currency by about 6.5%, 7% over last year. If that continues, you're going to see longer negative rates on a global front. And yes, there's a lot of scares out there at the moment.
I mean, is the one arena to hide oneself at the moment the gold sector? And so many fund managers are loath to pick gold shares or gold as an asset, but and there was a little bit of a retracement on the gold price today, for example. But is it maybe a good idea to have a little bit of your money?
I think it's going to turn out to be a very good investment, because you're quite right. The bond market is telling you that all is not well in the global financial system, and the scary part you were mentioning about the Italian banks. Italy would like to recapitalize a lot of those banks, but they are hamstrung by European rules. So that's going to come to a head soon. And I think gold essentially will be the beneficiary, although it doesn't cost you, there's no interest on gold, but at least your money should. It's always been a good hedge against weaker currencies.
Yeah. The other scary thing that took place today is UK property funds halting redemptions. And now I think there are 3 property funds. It was Standard Life yesterday, Aviva, and also a company called M&G. And there's a question asking about Capital and Counties looking quite attractive at this moment, and also Brait. And those 2 stocks got sold off quite heavily today. And I'm sure it's because everyone's just really property stock negative. Capital and Counties being exposed to the London market, that just got sold off. Gerbrand, do you think it's being unnecessarily sold off and that it is quite attractive, or is it a case of genuine change in its fortunes?
Yeah, look, I think if you look longer term, I think it's an opportunity. Longer term wise, similar things happened in 2008 in that specific market, and in some of the German markets as well. So there's not too much liquidity in most of these sectors, and it's similar in South Africa. The property count has been doing very well for a long time period, and the liquidity on those are just not big. So when you get redemptions in these funds that fund managers do manage, it's very difficult to exit when there's no buyers, and most of the times you have to take 10 or 15 or 20% lower in some of those counters. I think it's a nice defensive mechanism to protect the other investors in those funds. Probably something that should happen, but it is scary times, but scary times normally are opportunities.
Greg, your thoughts on capital and counties?
Look, we mustn't kid ourselves. There's been a significant change that has happened, and we don't. But the problem is, at the moment, nobody knows what the final outcome will be. The negotiations, it's all very well to say, well, Europe must try and punish the UK now. It's not that simple, because they're both dependent on each other. So, but there's concerns about, so I think that at these levels, there's actually some opportunities. Opportunity to buy pounds, because it's at a 30-year low, and these are some, you know, these funds that have been gated, they're not, there's nothing subprime about them. These are quality London, UK properties. But of course, it's a liquidity problem, because they can't just, with property, you can't just sell it overnight. So they will have to probably borrow against the properties for people who want to get out. But I don't see it as a Bear Stearns event or a Lehman type event. But in terms of capital and counties, I think that, yes, it's to be expected the share price would come down like that, but I think it's completely overdone, because we're still a long way from knowing exactly what the effect will be. And if the UK keeps its so-called passporting rights for financial services, then I think these shares will bounce back quite quickly.
And what about Brait? Because that's also been sold off. It has got big UK companies within its portfolio. And it seems to be now, I think, trading at its net asset value,
which it should be doing.
But it's always traded at a premium to its net asset value.
Well, look, they've done about 77% over last year net asset value growth, and a lot of people think they can probably do it again, and that's why they were trading at a premium. But if you're a holding company like they are, you shouldn't normally trade at a premium. So fortunately, because of the last fact, we own nothing of these because they were just too expensive. You can't pay 20% premium to some of the underlying if they actually pay a discount. Yes, they got new, they got the Virgin business in there. They got the Premier Fishing, Premier Food business in there.
Iceland Foods?
Icelandic Foods. So they sold the Pepkor deal last year nicely to Steinhoff, I think at a bit of an expensive price. They purchased these other companies at a discount, but they re-rated them at where the peers are trading on an EBITDA valuation. So it's not just that they made 70%. They paid, probably sold to a higher price than what Pepkor were worth, and they bought other companies which they re-rated on how they value those companies. So it's a bit of both, but it's just coming back to where it probably should. If you look at other companies like Foschini's and Truworths and those, I think they were hammered much more on Brexit and out of context than what a company like Brait has.
Greg, your thoughts on Brait? So if it is approaching fair value, I mean, is it fair enough value for you to buy it now, or would you want it to be a little bit cheaper?
You know, if anyone who's got access to a chart package, if you overlay the chart with the US dollar sterling rate, you can see as the pound has been weakening, anything with these sterling type stocks with exposure to UK have just been going in one way. And today at a 30-year low, so it's not impossible that the sterling, or cable as they call it, the US dollar pound, can go below 130, and then it's technically it's anyone's guess. So the weaker the pound gets, I think these shares could still come under further pressure. Yeah.
And it does seem to be weakening this evening. So I think you know, during the day it hits the pound hits they was talking about a 31-year low of, I think, 130.51, but it's when last I checked it was about 130.40.
Yes,
so
it was below 131.
Inching back to that level.
That 130, I would suggest, and I'm not a technician, but I would suggest that's an important level.
Okay. What is the panel's view on Hulamin? I'm glad you're in the studio this evening, Gerbrand, because you've picked this one before.
Yeah, it hasn't done anything.
Have your thoughts changed? Or?
No, not at all. I think we need to wait for earnings to come out. And it should be somewhere now in the next month. So until that, I'm not changing my mind. If something in that figures are disappointing, then you probably should change your mind. But it has been a volatile ride, up and down and up and down. So it's actually gone nowhere in the last year or two. but it should have decent numbers. And hopefully it will come out now that it actually can go for a bit of upward momentum at the moment.
But just what would your investment case be? Why would you be holding on to Hulamin? So numbers notwithstanding, what?
Look, they had that recycling plant that I think they're getting 40 or 50 million grant for that. There is earnings that are going to come through, and there was once-offs last year in the numbers. They are totally not dependent on Eskom anymore. They have translated it first to LNG or something, the total operation at the moment. So they've backward integrated with their Bayside BHP Billiton's old business from the aluminium point of view. So a lot of good things has happened there, but you haven't seen it in the numbers yet. And I think it's going to show this time around. If it doesn't, I'll start to get a bit concerned.
Greg, do you look at Hulamin?
No, not.
Okay. Moving on then. Liberty Holdings has been cheap for a while. It's currently on a PE of about 7.9 times earnings. Besides the business being partially dependent on rising financial markets, is there something fundamentally wrong with the business, as it never seems to be among the options or the choice of those money management professionals who want exposure to the SA life assurance sector? And then also with the rand showing signs of life versus the dollar and growing concerns around global GDP growth, is Trencor a value trap, as a large chunk of its worth is in the New York Stock Exchange listed Textainer Group? So that's the second question. But Liberty Holdings, no one ever, they're right, no one ever seems to pick it. So if you had a choice between Sanlam, Old Mutual and Discovery even, Liberty hardly ever gets a mention.
Well, I think if you look at it, it's, you know, if you look at Sanlam, they've got the emerging markets businesses, percentage in the Indian life business, they've got investments in emerging markets like Indonesia and things like that. Old Mutual have got their offshore. So Liberty seems to be a lot exposed to the domestic market. So I think it's a well-run company, but yes, it could be probably suffering from people believe it's not exciting enough.
Although, I mean, they have made strides to grow the African business. And
yes, they have.
Look, medical insurance business.
Yeah, I think it's a good, you know, traditionally Liberty has operated in the higher net worth space. I think that's where they like to operate. So whereas the other insurers and with Sanlam, you know, have had and MMI have gone for the broad-based market. So I suppose that, you know, the high net worth market is also suffering a little bit.
And will suffer, I suppose, if all their equity investments start declining tremendously in value. Gerbrand, would you be buying Liberty?
Everything has a price. We don't think it's there yet, so we're a bit concerned on the growth rate of the new business and the embedded value over time. There, Mutual and Sanlam has done much better jobs over the last few years, and even Discovery. Although Discovery is probably the pricier one of all of them at the moment. So I'll still be a bit wary on Liberty because they're not growing their new business quite as well as the other ones, and the embedded value is still not cheap enough, but it's cheaper than what Sanlam's were a while back. But I haven't done those calculations in the last month, so price movements might be
have skewed things.
The moment, yeah.
Okay, we'll talk about Trencor after the break. If you'd like to send questions, please do text us, stock in the question to 33814 or email us, and we'll be back shortly.